Good morning, students. Now we are on the fifth chapter, that is the banking, in which we will discuss about the commercial bank and the central bank, in which we will discuss about the work of the commercial banks, meaning of the commercial bank, and the basic functions of the commercial bank. After that, we will move to the central bank, which is the apex banking institution, uh, in which we will discuss about the functions of the commercial bank, and later then we will discuss how the central banks was control the credit. Before that, we will go to the history of the banking system. When we talk about the history of the banking system, the first Bank of India, which is called the General Bank of India, was established in the year 1786. The East India Company established the Bank of Bengal, which is known as the Bank of Calcutta also, in 1809, Bank of Bombay in 1840, and the Bank of Madras in 1843. And these three banks was called as a presidency bank at that time. After then, the Allahabad Bank was, which was established in the year 1865, was the first time completely run by the Indians. And now the first Indian bank, which we know that the first Indian bank is the Punjab National Bank, which is established in the year 1894 at the Lahore as a headquarter. In 1921, all the three presidency banks which we discussed, that is the Bank of Bengal, Bank of Bombay, and the Bank of Madras, were emerged to form the Imperial Bank of India, which was run by the European shareholder. After then, the Reserve Bank of India was established in the year 1935. That's the history of the banking system. When we discuss about the central bank, basically the main work of the central bank is to control the money flow in the economy. The first central bank of the world, which is established in the 17th century, the banking system was started in the world is the 17th century. The first institution which is known as the central bank was a Swedish central bank, which name is the Riksbank of Sweden, which is established in the 1668, and it's a joint stock bank. After then, lots of the bank was established. Some banks are there. The Central Bank of the England was established in the year 1694, and the Bank of Scotland established in the 1695. And the Central Bank of the USA, its name is the Federal Reserve Bank, which is established in the December 23, 1913. And the Central Bank of India, which name is the Reserve Bank of India, as you know, that is the RBI, which is established in the year 1st April 1935, and it is nationalized in the 1949. The main work of all the central bank is control the monetary policy and the financial stability in the country, which regulate the currency flow and the credit system of the country. All the banks of the world, the central bank will do the same work for the economy. Now let's move to our main topic, that is the commercial bank. A commercial bank is the financial institute which basically perform two activities, which accept the deposit from the public and offers the loan to the consumption or the investment purpose. Basically, there is a difference between the financial institutes and the banking system. Financial institute will only perform one activity. Either it will accept the deposit or either it will advancing the loan. But the bank who perform these two activity is become a bank. The bank will do these two work, that is accept deposit and advancing the loan. Acceptance of the checkable deposit is the necessary but not sufficient condition for the financial institution to become a commercial bank. Like post office are not a bank even though they accept the check deposit from the public. This is because they do not perform the function of the lending. It means it will not lend the loan to the public. Similarly, some other financial institutes are also there, where like the LIC and the UTI, which gives loan but do not accept the checkable deposit like the bank. Is that clear? That's why these two are the financial institutes, and the bank are totally different from this financial institution. Now, basically, there is two functions of the commercial bank, as we discussed earlier, that are accepting deposit and advancing loan. Basically, the commercial bank has the two types of a deposit. One is the demand deposit and the second is the fixed deposit. Demand deposit is also known as a checkable deposit, which we will discuss later, and the second is the fixed deposit, which is the time barred. And the advancing loan is the primary functions of the commercial bank, which generate the income for the commercial bank, and in behalf of that loans they accept the security also. Now the first function of the commercial bank is the accepting deposit, that is the demand deposit. Demand deposit are those deposits which are repayable by the bank on demand, or we can say that the public can withdraw at any time, and this is the checkable deposit also. This can be withdrawn any numbers of times. No interest is paid on such kind of a deposit. These deposits are made by the businessman to carry out their day-by-day transactions. And the second is the fixed deposit. Fixed deposits are those deposits which can be withdrawn only after the expiry of the particular time periods. It means we can say that a fixed deposit is a time bought. We cannot withdraw before that time period. Clear? And in behalf of this fixed deposit, no check will be issued, or it means we can say that it can be withdrawn at any time. Second function is the advancing loan. The loan are offered against some collaterals. That is a very important conditions for the banking system, that the collateral or the security will be must to hand it over to the loan or provide the loan by the bank to the public. Bank charge interest from the borrowers, and this is the main source of their income. Modern bank gives mostly secured loan. Secured loan means it will accept the collateral from the public, and after then he gives the loans. They demand the proper security or the collateral in behalf of to providing the loan. Generally, the value of the security or the collateral is equal to the amount of the loan. This is done mainly with a view to recover the loan money by selling the security in the event of the non-refund of the loan.